More and more super investors are closing their positions and getting rid of AT&T shares. But the stock is doing very nicely. In 1 year, it is up by 18.2%, and their dividend yield is an impressive 5.9%. So is this a dying company that will slowly get weaker and weaker, and that is why super investors are leaving? Or is AT&T getting back up on its feet after spinning off Warner Bros. And decreasing its huge debt? Well, let's try to find out. If you were to invest $1,000 into this company 10 years ago, you could buy around 38 shares, and now they would be worth something close to $709. Not a great beginning. Luckily, AT&T also pays dividends, so in that time you would get $680 as dividends. So if we add together the current value of shares and the dividends, we get $1,389. And that is a gain of 39% in 10 years. Not great, but you would also get shares of Warner Bros. Discovery after the spin-off in 2022, so the real result would be a bit better. Individual insiders, that is an X, only 0.1% of the company is owned by individual insiders, and we would like to see this number over 2%, so that is not a lot. And are individual insiders buying? That is a check. In the last year, they bought 62,500 shares and didn't sell any of them. So the management seems to believe in the future of AT&T. And do super investors own this company? That is a check. We see that 2 of them invested in AT&T. And are super investors buying right now? That is also a check. In the last quarter, Bill Miller bought 36,000 shares and other investors sold over 30,000 shares. But it is worth pointing out that Lee Ainsley and Kahn brothers decided to close their positions altogether, following in the footsteps of David Roth and David Katz. So the number of super investors is steadily going down. Return on invested capital, that is an X at 5.2% 10-year median returns. And we want to see this number higher than 10%, so that is disappointing. And what do we know about net profit margin? It is a check at 5-year average of 4.1%. And the sector median is 3.3%, so that is not bad. And now let's take a look at share buyback. It is an X. They issued extra 37.3% of shares in the last 10 years. So they are diluting long-term investors in a massive way. And the debt? It is also an X. It would take them over 5.5 years to pay the long-term debt with a current free cash flow. So that is a serious problem. They got rid of some of it thanks to the spin-off of Warner Bros., but this situation is not yet resolved. Revenue growth, that is an X at minus 0.5% 10-year compound annual growth rate. That is something we really don't like to see, a declining revenue. And how is free cash flow growth looking? It is an X at 4% in the last 10 years. So at least it is growing, but not by much. And earnings per share growth? That is an X at minus 5.4%. And this result is so bad partly because of the dilution. If there are more shares available in the market, each share is worth less. And this is an example of that problem. The dividend yield is 5.9%, so shareholders can expect to get $1.11 annually per every share. And the payout ratio, that is a check at 47%. And we want to see the payout ratio somewhere between 20 and 50%. So that is very nice. We are getting almost half of the earnings through dividends, but the other half can be used to grow the company, or in case of AT&T, it can be used to pay off some of the debt. And what about dividend growth? It is an X at 0% 5-year growth rate. They were a dividend aristocrat, but since they cut their dividend in 2022, they lost this status. And now they will have to decide, do they want to rebuild that? Or should they keep the dividends more dependent on the financial results of the company? Price to earnings ratio is 10.1, so that is very encouraging. AT&T may be a buy right now. But to figure that out, we will have to estimate the growth of this company for the next 10 years, and we will make 3 scenarios. So in the low scenario, we will estimate a growth of -2% for the first 5 years and then 0%. In the medium, 2% growth and then 0%. And in the high scenario, 5% and then 3%. So the low scenario is predicting that AT&T will be shrinking instead of growing. Medium is showing a future in which they will almost not grow, and the high one is close to the predicted global growth of the telecommunication market, which is around 5.3%. So with such estimates, the intrinsic value in the low scenario is $14, in the medium $19, and in the high scenario $28. But we have to always apply a margin of safety to those prices. I use a 30% one. And with such a margin, we get in the low scenario $9, in the medium $13, and in the high one $20. And the current price is around $19. Medium scenario without the margin of safety is in the green, and also the high scenario even with the margin of safety is in the green. So it seems that AT&T is somewhere close to its fair value. Let's open our stock ranking and let's take a look at the overview of AT&T. So here we have all the data, and here is our overview. And as we can see straight away, the financial health and the growth are really bad. The dividends seem interesting, and they are probably the reason for such an engagement from investors. So what is the bear case for AT&T? Well, first of all, they have a significant amount of debt. They are paying it back, but it is a burden. It influences the company's financial flexibility, increases interest expenses, and limits its ability to invest in growth opportunities. AT&T's traditional wireline and satellite TV businesses are in decline. The shift to streaming services has reduced the customer base for DirecTV, leading to revenue decline in these segments. AT&T needs to invest in new technologies such as 5G and fiber networks to stay competitive. Failure to keep up with technological advancements could lead to a loss of market share. And it's hard to innovate and expand with debt payments pulling you back. And what is the bull case? AT&T has historically provided a high dividend yield, which makes it attractive to income-focused investors. If the company can sustain or grow its dividend, it can continue to draw and retain long-term investors. The spin-off of Warner Bros. In 2022 allows the company to simplify its operations and focus on its core telecommunication business. This strategic shift can improve efficiency and financial performance. And finally, the increasing reliance on digital connectivity for work, education, and entertainment creates ongoing demand for AT&T's services. This trend can ensure that AT&T will not only remain as one of the main players in the market, but that it will grow with it. If you enjoyed this video, then check out some of my other analysis. Thank you so much for watching and see you in the next one.